How do I roll over my old 401k? Can I contribute to my 401k and my IRA in the same year? Can I transfer money from my savings account into my IRA, or is it deducted from my paycheck? These are all common questions we hear about funding your IRA. An IRA can be a great investment vehicle, but when you start funding it, you have to be sure to follow the rules. Hi, welcome back to BrightWealth. My name is Scott McLaine. I'm your host and I'll be your instructor for today's lesson. As always, we are here to accelerate your financial success. In this episode of BrightWealth, I'm going to break down stage 2, funding your IRA, and I'm going to answer the most common questions. So let's dig right in. When you first open your IRA, it doesn't have any money in it. It's just a blank investment vehicle. You need to put money into it and then again, ultimately invest that money. And so there's two primary ways to put money into your IRA. The first way to fund your IRA is through annual contributions. The second way is through rollovers and transfers. So let's go ahead and take a look at annual contributions. When you're contributing to your IRA, you can have a certain amount of money that you can put in each year. The minimum amount that you have to put into your IRA is zero. So when you're talking to financial professionals out there in the finance space, or friends, family, whatever, if they're not securities licensed, they might be trying to open up insurance policies for you as part of your retirement vehicle or part of your retirement account. And if you're using insurance as your retirement, then there's going to be a required monthly minimum every single month that if you're saying, I'm going to put $300 a month in my account, you have to put $300 a month every single month into your account. Otherwise, you could collapse that insurance policy. So I'm just going to caution you, when you come to a retirement account that requires a minimum amount of money each month, you want to make sure that you double check that with your financial advisor before you purchase something like that. And I mean a licensed securities professional. So when it comes to an IRA, an individual retirement account, there's no monthly minimum. You don't have to contribute. If you end up having a lot of expenses at home one month and you don't want to put the $300 into your IRA, there's no sweat, there's no worries, there's nothing at all. And so that's the minimum. On a maximum, under the age of 50, you can contribute up to $6,000 a year. So for this type of a vehicle, an IRA, you can put up to $6,000 a year into your IRA. The maximum that you can put if you're over the age of 50 is $7,000 per year. And so you can put a certain amount of money in. That money goes in pre-tax. And you have a deadline though. Each year you have to put your money in every year or you miss that opportunity for that year. And so right now we're in the year 2021. Your deadline is April 18th of 2022. And so as long as you have your money, as much as you want to put into your IRA by that deadline date, that will count for the 2021 year. Now, things to consider when you're contributing into your IRA. Do you want to contribute it all at once? Or do you want to contribute it periodically? And that's another option that you have. So if you have money set aside over in your brokerage account or in a savings account and you just want to put the $6,000 for the year in, let's say on the day after tax day, April 23rd, and you put all your money in, that's a great scenario, and many people do that because then your full amount in that IRA is compounding all year long. If you're making monthly contributions throughout the year, then you're slowly adding money to your account and compounding the bigger amount by the end of the year. Now, so you have an option, all at once, periodic, there's no set schedule that you have to do. Your money that goes into your IRA is going to come out of ordinary income or earned income, and your contributions are going to be tax deductible. We're going to talk about that in a minute, but what that means is that if you put money into it and if you earn a certain amount of money, that money is deducted off of your ordinary income for that particular year. Now, If you earn over $66,000 in a year, let me go back. If you earn under $66,000 a year, then 100% of the money that you contribute to your IRA is tax deductible. For example, let's say you made $66,000 in a year and you contribute $6,000 to your IRA, then as far as taxes are concerned, you will only have earned $60,000 for that year. And you guys can see that right here, down here. So by making that contribution, not only do you get money into your IRA, you actually lower your amount of money that you earned that year by that contribution amount. Now, if you go over $76,000 a year, anything between 66 and 76 will be partially deducted off of your current year's taxes. Anything over 76,000 as an individual putting money into their IRA will be able to go into the IRA and compound and grow in a tax-deferred environment, but you won't get the credit on this year's taxes. So that's the difference there. And so if you're married, your limits are a little different. You're $105,000 as a married couple filing jointly. And if you earn as a married couple jointly filing, both of your salaries added up, total income for the year is under $105,000, then the full amount going into your IRA will be tax deductible. If you earn between $125,000 married filing jointly and above $105,000 and under $125,000, then your amount will be partially deductible. And if you earn as a combined couple over $125,000, then again, you can put money into your IRAs, but you cannot get the tax deduction on it for that particular year. Married couples also have a unique situation that if only one spouse is earning income and the other spouse is not, you can still contribute to 2 IRAs. So a married couple under the age of 50 could technically contribute $12,000 to their IRA instead of just the 6, even if only one spouse is working. And that's a great way to get more money growing for you in a tax-deferred environment. Now, that is the way to contribute to your IRA through annual contributions, $6,000 a year or $7,000 a year per spouse or individual, and that happens year over year over year. If you have an old retirement account that you're no longer working at that company, you can also roll over or transfer that balance. And the 4 most common accounts that you can roll over or transfer to your IRA are a 401k, a 403b, a 457, and other retirement savings plans. Now, these 4 types of retirement accounts are great for transferring money or rolling money over into your IRA, but there are some rules. One is that you're no longer employed at that company. And so as long as you're no longer employed there, you can transfer that balance over. Also important to remember that rollovers and transfers are not taxable. So if you're rolling $175,000 over from a 401k into your IRA, you're not going to pay any tax on that. And finally, rollover checks, if you receive a rollover check, that must be deposited within 60 days. Now, what's the difference between a rollover and a transfer? That's a big question that we get all the time. A rollover is a check that is actually physically mailed to you from the financial institution, and the check shows up at your house, made out to the brokerage account where your IRA is open on behalf of your name. So what that means is if you worked at a company for several years and you grew a 401k balance, let's say to $175,000 like we used in our example earlier, and that money is sitting in that 401k previous employer and it's just sitting there, you can contact that company and say, I want to roll that over to my new IRA that I've recently opened. And what they're going to do is they're going to mail a check to you in the name of the brokerage account where your IRA is and for your benefit. And you'll receive that check, and then you have 60 days to mail that check to that brokerage and they will deposit it into your account. Another way to do it is a transfer. It's a very similar process. In that case, the money just transfers directly from your old 401k right into your IRA. And so that's really the five, or really what goes on funding an IRA. Just to recap, you can do annual contributions or you can do a rollover. One common question that we also get is, if I roll over $175,000 into my IRA this year, can I also contribute $6,000 this year to that IRA? Can I do both? The answer to that is yes. So if you have an old 401k and you transfer that balance over, that can go into your account this year. And you can also contribute up to $6,000 if you're under the age of 50, or $7,000 if you're over the age of 50 into your IRA for that current year. So I hope you found value in today's video. Please follow and subscribe to the BrightWealth YouTube channel. If you have any generalized questions, you can leave them in the comments below. We love answering those. If you have any specific questions about an IRA or your IRA for yourself, click the link below to schedule a one-on-one planning session with the Bright Advisor team. They're happy to meet with you. My name is Scott McLaine, and as always, it's not what you make, it's what you do with what you make.